Hey introverts, it's your boy Gary T, and I'm back with another edition of the Real Estate Terminology series. Thanks so much for tuning in. We're diving right into 12 more terms and acronyms that you should know as a beginning real estate investor. This will get you ahead of the game. If you're ready to dominate, smash that like button, hit that subscribe button, and let's jump right into it with the first acronym. First acronym is HELOC. Stands for Home Equity Line of Credit. It's like having a black card for your property. It allows a homeowner to borrow against the equity in their home up to a preset limit. You tap into the value of your home, but remember you got to pay it back with interest. But it's your secret weapon to seizing new opportunities. And if you stick around to the end, I'm going to give you guys a bonus terminology. What is equity, you ask? Well, that's the second term on our list. Equity is the difference between the value of a property and whatever is owed on that property. So if you have a property that's worth $500,000, but you only owe $100,000, you have $400,000 in equity. Moving on to our next term, which is NOI. NOI stands for Net Operating Income. It's the income generated after deducting all operating expenses such as PITI, management fees, and maintenance. NOI is the money that's in your pocket after all the business costs are stripped away. Term number 4 is going to be IRR, Internal Rate of Return, which is calculating the potential profitability of an investment. It considers the time value of money, which we can go over on a different video. But you're not just investing with an IRR, you're actually looking into a crystal ball and seeing how profitable the rate of return would be on a particular investment. Next one we will dive into is the cash on cash return. This ratio measures the annual cash income generated by an investment property compared to the initial investment. So for example, if you pay $50K cash and you expect $500 of rental income a month in your first year, that's $6,000 divided by 50,000. That will give you a cash on cash return of 12%. So the next one we'll dive into is capitalization rate or cap rate. It's a percentage that indicates the potential return on investment based on the NOI relative to the market value. Next one we'll talk about is cap rate. It's a percentage that indicates the potential return on an investment based on the NOI relative to the market value. This is usually reserved for multifamily investing. All right, folks, we're moving on to the next term on our list, which is hard money and private money loans. Hard money loans, one is like a tough love lender, and the other one is like borrowing from a rich uncle. Choose wisely, because these loans can make or break your deal. Hard money loans are typically higher interest rates and are secured by the property itself. So if you default on a hard money loan, the lender has a claim on the underlying asset, which is the property. Next one is EMD. EMD stands for Earnest Money Deposit. It's money that's deposited to an escrow account by a buyer to show the seller they're real when entering into a real estate transaction. It's a sign of commitment and seriousness, and sometimes it could be a non-refundable EMD. And the next term we'll dive into is Capex, capital expenditures. These are funds that are set aside by an owner for future major expenses such as a water heater or a roof needing to be replaced. Think of it like the investment that keeps your empire strong. It's like keeping your car shiny once you buy a new car, or when you buy a new iPhone, the first thing you get is a case in case you drop your phone and break it. You don't want to have to pay another $1,000. So you buy the case, you pay the $50 for the case to save your money. Next one we'll talk about is amortization. What is amortization? It's the process of slowly paying off your debt. So when you hear a term like the loan is being amortized over 30 years, that means it's being paid off over 30 years. 30 years is the term. Next one is loan to value. loan to value is all about leverage. You want more bang for your buck. And LTV shows you just how much power you've got when you're taking on deals. It's the ratio that compares the amount of the loan to the value of the property being financed. So if you're financing a $100,000 property and you only put 10% down, your LTV is 90%. Most lenders would want you to be at 80% or lower. Next term is appreciation and depreciation. Appreciation is basically an increase of value, while depreciation is a decrease in value. Both can be found in real estate depending on market conditions, and both will have differing tax implications that may be beneficial to a real estate investor. And now that you guys have stuck around to the end, as promised, here is the bonus term, a 1031 exchange. What is a 1031 exchange? Well, are you ready to play smart with taxes? Enter the 1031 exchange. It's a tax deferral program where you trade in a property without Uncle Sam having a hand in your pocket. So you keep more of your hard-earned cash. So let's say you sell a property and you've made $300,000 in profit. If you do a 1031 exchange and roll that money into your next property, you will defer paying taxes on that gain. So it's a very advantageous tax plan. All right, introverts, you're armed with the knowledge to dominate the market. Hit that subscribe button for more content like this. And until next time, keep crushing it. If you've got any suggestions for new videos that you'd like me to make, go ahead and leave a comment down below. Thanks again for watching.